On June 30th, 2026, the Investment Company Institute released its official monthly data. The number that matters most for this video, the combined assets of the nation's indexed mutual funds and ETFs hit $21.82 trillion in May 2026. That's up $1 trillion in a single month. To put that in context, the entire US GDP is approximately $29 trillion. Index funds now hold roughly 75% of the entire annual US economic output. In May alone, long-term index funds pulled in $96.47 billion in net inflows. Active funds, by comparison, saw equity funds post an outflow of nearly $32 billion. The passive investing revolution that John Bogle started in 1976, when he launched the first index fund for individual investors at Vanguard, has now completely reshaped the American financial system. And here's the question that the smartest economists in the field are starting to ask seriously in 2026. What happens when passive investing becomes so dominant that it starts breaking the very markets it's supposed to track? That's the honest question this video is going to answer. But I want to start by giving you the full picture of what's actually happening in the H2 2026 investment landscape. Because the data from Kiplinger, Morningstar, and Invesco's mid-year outlooks reveals something genuinely surprising. Then I'm going to pair it all with the most important book ever written about index funds, The Little Book of Common Sense Investing by John Bogle, and ask whether Bogle himself, if he were alive today, would see this level of passive dominance as the triumph of his vision or as a new risk he hadn't anticipated. Welcome to Earnings Per Page, Honest Finance, No Hype. Hit subscribe. Let's get into it. Part 1. The H2 2026 investment landscape, what the data actually shows. Let me give you the real mid-year picture before getting to the index fund paradox. The first half of 2026 was marked by significant volatility. The broad market peaked on January 27th, 2026, one day before gold hit its all-time high of $5,589. Then the market sank more than 9%, a whisker below the 10% threshold that marks an official correction. But it recovered, and the year-to-date winners through June 26th are, according to Morningstar's June 29th update, small cap stocks, not large cap AI names, not mega cap tech, small caps. The Russell 2000 Small Stock Index has outpaced the S&P 500 over the past 12 months, year to date, and since the market bottomed on March 30th. This matters enormously for index fund investors who assume their S&P 500 fund is capturing the whole US market story. It isn't. It's capturing large and mega cap stocks, while small cap outperformance is happening largely outside the index that most passive investors actually hold. International stocks have continued to outperform US stocks in 2026 for the second consecutive year. More favorable monetary policy in Europe and Japan, Japan's ongoing corporate restructuring, and the dollar's weakness have all contributed. The investor who holds only a US S&P 500 index fund has meaningfully underperformed a globally diversified portfolio for 2 consecutive years. And yet, despite this underperformance, $96.47 billion flowed into index funds in May alone. The behavior and the evidence are diverging. Part 2. The SpaceX IPO, the most important index story of 2026 that nobody is covering. Here's the story hiding inside the index fund data that US News covered on June 16th and that almost no financial YouTube channel has discussed. The blockbuster SpaceX IPO has stirred considerable controversy among index providers. Major index providers, including NASDAQ, FTSE Russell, CRSP MSCI, and S&P Dow Jones indices, have spent much of 2026 debating whether SpaceX should receive fast-track admission into flagship benchmarks. At the center of the debate is seasoning, a set of requirements designed to ensure newly public companies establish sufficient trading history before being added to major indexes. When SpaceX is eventually added to major indexes, and it almost certainly will be, every single index fund that tracks those indexes will be automatically forced to buy SpaceX shares, regardless of price, regardless of valuation, regardless of fundamentals. This is the mechanical reality of passive investing that most individual index fund investors don't understand. When you own an S&P 500 index fund, you automatically own every company that gets added to the index, at whatever price the index dictates, on the day they're added. If SpaceX enters the S&P 500 at a $300 or $400 billion valuation, Every passive S&P 500 investor becomes a SpaceX shareholder on that day, with zero input from them. Part 3. John Bogle's original argument and why it was right. The Little Book of Common Sense Investing was published in 2007, the year before the financial crisis. But Bogle had been making the same argument since 1976 when he launched the Vanguard 500 Index Fund, the first index fund available to individual investors. His argument was elegant in its simplicity. The stock market, in aggregate, generates a return equal to the aggregate return of all U.S. businesses. Every investor, in aggregate, earns exactly that return before costs, after costs, the management fees, trading expenses, and taxes of active management. Investors as a group earn less than the market return. This means that the average active fund, by mathematical necessity, must underperform a low-cost index fund over time, because the index fund takes almost no fees, while active funds take significant ones. The data has consistently confirmed Bogle's thesis. Morningstar's active-passive barometer finds that less than 5% of active large blend funds survived and outperformed their passive peers over the past 15 years. Less than 5%. The remaining 95% of active fund managers, despite years of education, research departments, Bloomberg terminals, and star analysts, failed to beat a simple, low-cost index fund. Bogle was right. His math was correct. The revolution he started was justified. Part 4. The paradox Bogle didn't fully anticipate. Here's where the honest analysis gets complicated. Bogle's argument was built on a specific assumption, that the market is broadly efficient because of the research and trading of active investors who are continuously analyzing companies, discovering mispricings, and buying or selling accordingly. Index funds could ride on this active price discovery process, capturing market returns at almost zero cost, because the market was already being efficiently priced by the active participants. But what happens when passive investing becomes so dominant that the active price discovery mechanism weakens? When $21.82 trillion flows into index funds with zero analysis of individual company value, and only $32 billion flows into active stock picking per month. The ratio of passive to active has reached levels that economists have never studied at scale before. The concern is theoretical but increasingly credible. If markets derive their efficiency from active analysis, and if active analysis is being defunded by passive dominance, does market efficiency itself weaken over time? Some economists say yes. They call it the index fund paradox. Passive investing works because active investors maintain market efficiency. But if too many people go passive, they undermine the efficiency their passive strategy depends on. Michael Burry? Yes, the Big Short Michael Burry has argued that index funds are creating bubble-like conditions in large-cap stocks, inflating their valuations beyond what fundamentals justify, because index fund inflows mechanically buy the largest stocks regardless of price. Is he right? The honest answer is partially. Large-cap U.S. stocks have been trading at elevated valuations relative to historical averages. The concentration of index fund ownership in the largest names in the S&P 500, Apple, Microsoft, Nvidia, Amazon, Alphabet, does create mechanical buying pressure on those stocks regardless of fundamentals. This is a real phenomenon. Whether it constitutes a bubble or simply a premium that's sustainable given the liquidity and quality of those companies is genuinely uncertain. Part 5. What the H2 2026 data tells us to do. Here's the practical section, and I want to be honest that this is the most contested area of personal finance advice right now. The core Bogle recommendation remains sound for most investors. A low-cost, diversified index fund, specifically one that includes international exposure, not just US large caps, is still the most reliable path to long-term wealth building for the overwhelming majority of people. The active-passive barometer says fewer than 5% of active managers beat their benchmark over 15 years. That remains true. But there are two specific adjustments that the H2 2026 data suggests are worth considering. Adjustment 1. Global diversification matters more than ever. International stocks are beating US stocks in 2026 for the second straight year. An investor holding only the Vanguard S&P 500 ETF, VOO, is missing the international outperformance. The Vanguard FTSE Developed Markets ETF, VEA, provides low-cost exposure to international developed markets including Japan, where corporate restructuring is generating real value. The Vanguard Total World Stock ETF, VT, provides exposure to more than 10,000 companies across the entire globe with a 0.06% expense ratio. For most investors, VT or a combination of VOO plus VEA is more genuinely diversified than VO alone. Adjustment 2. Don't ignore small cap exposure. Small cap stocks are the 2026 year-to-date winner and have outperformed over the past 12 months. Yet most S&P 500 index funds contain zero small cap exposure. The S&P 500 is exclusively large cap. The Vanguard Extended Market ETF, VXF, provides low-cost exposure to mid and small cap US stocks that are entirely missing from a standard S&P 500 fund. Part 6. The SpaceX question and what it means for you. Here's the practical implication of the SpaceX index inclusion debate. When SpaceX is eventually added to major indexes, and the debate is about timing, not whether, every passive index fund investor will automatically become a SpaceX shareholder at whatever valuation the market has assigned on that day. This isn't necessarily bad. It's simply a mechanical reality of passive investing that you should understand. If you believe SpaceX is overvalued when it enters the index, you can take no action. You'll still own it automatically. If you want to express a view on SpaceX's valuation, either positive or negative, you cannot do so within a passive index fund structure. This is one genuine limitation of purely passive investing that Bogle's framework doesn't fully address. Final verdict on the Little Book of Common Sense Investing. Should you read it in 2026? Absolutely yes, especially if you're new to investing or haven't yet committed to a long-term strategy. Bogle's core argument is still mathematically correct. Costs matter. Diversification matters. Time horizon matters. Less than 5% of active managers beat index funds over 15 years. My rating, 10 out of 10 for foundational investing wisdom, 0 out of 10 as a complete description of the 2026 investment landscape, because Bogle wrote before passive dominance reached $21.82 trillion. The Honest H2 2026 recommendation: own index funds, diversify globally, not just US large cap, include small cap exposure, add modest international equity, keep costs low, and understand that when SpaceX enters your index fund, you'll own it whether you want to or not. That's the mechanical reality of the most successful investment innovation in history. Now large enough to reshape the markets it was designed to serve. If this changed how you think about index funds in H2 2026, subscribe to Earnings Per Page. Next time I'm covering the most important personal finance story for the second half of 2026, the definitive answer to whether the traditional 60-40 portfolio is dead or just wounded. Drop a comment with what percentage of your portfolio is currently in index funds. See you in the next one.